It is no secret that the stock market is at all-time highs and that the present bull market is the longest and most powerful in the stock market's history. And as a result, many people believe that the good times and big stock market gains will never end. Charlie Munger, who has never been reluctant to speak his thoughts, believes that this isn't the case, and he predicts that the coming decade will not be as prosperous as the previous one. Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. Charlie expects the next 10 years to have lower returns in the equity markets than the last. The returns will be lower in actual terms. Charlie Munger says that the first thing he says is that everyone is trying to get into this topic. This is due to the fact that the stock market rose steadily since the great financial crisis. The market has been in a frenzy for over a decade, according to Charlie Munger. Peter Lynch, another well-known investor, refers to this phenomenon as the cocktail party effect. When Lynch and his wife were at a party, a lot of people approached him and asked him which stocks to buy. He took this as a hint that the stock market was overvalued. When that happened, he knew that the market was too high and due for a decline. It seemed like we are seeing a lot of that today by the number of people saying that Warren Buffett is washed up because he won't buy tech stocks. The other thing that I want to draw your attention to, and I don't know if you caught it because it was pretty subtle, was that Munger said that real returns would be lower. The real return of the stock market is what the return is after factoring in the impact of inflation. That means that if the stock market returned 10% in a year, but inflation was 6%, your real return would be 4%. Or even worse, if the stock market return was 4% and inflation was 6%, your real return would be negative 2. By specifically referring to these returns, Munger points out that inflation is likely going to be higher over the next decade. So far, this does seem to be the case as inflation recently hit a 39-year high. This inflation is in large part due to the US government printing money, or to use a fancy finance term, quantitative easing. Here's what Munger had to say about that. What do you think of the combinations of quantitative easing and large fiscal deficit, and where are they going to lead us? Munger replied, "So there's my easy answer, which is that it's one of the most intriguing topics someone could ask, and we're in new territory. Nobody has ever gotten away with the type of money printing we're doing for an extended period of time without experiencing any difficulties. And I believe we're on the verge of experimenting with fire. I believe one thing I've found about a lot of successful investors is that they enjoy studying history. Throughout history, Charlie Munger has been no exception. There are numerous examples of governments that have printed excessive amounts of money and suffered devastating repercussions as a result. Germany in the 20s is a popular example. Germany was already suffering from high levels of inflation because of World War I, and the increase in government debt, workers in the country went on strike. And in order to pay the workers, the government printed more money. The flood of money led to hyperinflation. As the more money was printed, the more prices got out of control. That a loaf of bread, which usually cost 250 marks in January 1923, had risen to 200 billion marks at the peak of hyperinflation in November 1923. As I'm sure you've imagined, this caused a lot of unrest within the country, and many historians credit this hyperinflationary period as one of the root causes of the Second World War. Now, Charlie Munger is by no means saying that things will get that bad in America, but what he is saying is that the government prints a lot of money, things don't end well. Inflation is something we as investors need to keep in mind because it will affect the real return we receive from the stock market. Another thing that will affect our return over the next decade is the current prices of stocks. Obviously, if stock prices are too high, future prospective returns will be lower. So this brings us to the big question, or in the case of Charlie Munger, billion-dollar question. Are we in a bubble? When we think about fundamental investing, this means that the value of a stock is based on the cash the underlying business will produce in the way of profits over the lifetime of the business. However, sometimes the stock market gets ahead of itself and the price for stocks is higher than the true value of the underlying. Let's look at the Nasdaq, which is an index of mostly tech companies. This index at a high of around 4,800 in March of 2000, at the peak of the dot-com boom, investors became overly optimistic about prospects for these new tech sectors. It took until 2015 for the Nasdaq to recover to the levels observed at the pinnacle of the dot-com boom. After which, investors who bought at the peak of the bubble had to wait 15 years to break even on their investment. Consider how much corporations on the Nasdaq such as Apple, Amazon, and other high-growth tech firms increased over that 15-year span. This is because the Nasdaq's price level has gotten so far ahead of the underlying value of the companies that the current level of the stock market has some investors worried that, again, prices in the stock market have gotten ahead of the underlying fundamentals of the businesses. Another important thing that needs to be discussed is just how big the world's largest companies have gotten. Believe it or not, the 5 largest companies in America account for 25% of the entire value of the S&P 500 index. That means for every dollar an investor puts in a market cap weighted S&P index, 25 cents of that is going into the stock of the 5 largest companies: Apple, Microsoft, Alphabet, Amazon, and more recently, Tesla. This means that a lot of returns over the next 10 and 20 years in the stock market will be based on the performance of these companies. However, Charlie's quick to point out that the successes of these companies are far from what we think. Here's what he had to say. Charlie says that companies of America behave more like biology than they do anything less, and all the individuals die, and so do all the species. It's just a question of time. What happens in the economy to all the things that were really great when I was young ever seated the normal? And new things have come up and some of them have started to die. And that is what the long-term investment climate is. That does make it very interesting. It was just a few years ago when a big topic of conversation in the finance community was which company would be the first to break the trillion-dollar market cap threshold in just the past few years. Multiple companies have shot past that $1 trillion market cap level and are now even approaching $2 trillion and even $3 trillion. But just because these corporations currently hold dominant positions does not ensure they will continue to do so in the future. According to Charlie, some people are undoubtedly harming the other people rather than being depressed themselves in order to stay on the cutting edge. And then there's Googles, the Apples, others like myself, according to Charlie, do part of this by joining things like Apple, and in some ways we simply try to avoid the big change that we believe will harm us. As a result, you can't think of a more old-fashioned business than a railroad firm. But who in the heck is going to establish another railroad? Take Berkshire, for example, which operates on the Burlington Northern Line. That's a very good asset for us. So we made that success, actually not by concrete change. To really drive home the point, take a look at this chart that Warren Buffett talked about at the most recent Berkshire Hathaway annual meeting on the left. It shows the 20 largest companies by market cap in March of 1980. On the right, it shows the largest 20 companies by market cap in March of 2021. How many of the companies from 89 made the list again in 21? Not a single one in 1989 were the companies like ExxonMobil, General Electric, IBM, Philip Morris, and Merck. In 1989, these corporations all held extraordinarily dominant positions, and most people would have assumed that they would continue to do so indefinitely. That is, however, was not the case. We have wonderful firms like Apple, Microsoft, Amazon, and even Berkshire Hathaway, the conglomerate controlled by Warren Buffett and Charlie himself, at number 1 on the list in 2021. The key thing to evaluate is how many of the companies on the list in 2021 will be on the list in 30 years, or even better, 2051. With the major corporations accounting for such a large share of the S&P 500, how many of these companies will actually be on the list 10 years from now? If they do struggle, it could hinder the return performance for investors because such large portions of the average investor's portfolio is invested in these giant companies. And finally, Charlie has some advice for a few investors out there and how they can succeed over the next few decades. He said, "I spent a lifetime trying to avoid my own mental biases. I rub my own nose, and my own mistakes are I try to keep it simple as much as I can, and I like the engineering concept of merging safety. I'm a very blocking and tackling kind of a thinker. I just try and avoid being stupid. So I have a way of handling a lot of problems. I just leave them where they are now. I'm not putting too much effort into my work. But in my opinion, it is the single most important factor. If you still want to dodge it all, the key is recognizing where you are competent and where you aren't, as well as knowing the edge of your own competence. And that's difficult because their minds automatically want to convince you that you're far brighter than you are." Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.